10 trading strategies. This video shows you 10 trading strategies where we trade different assets classes. You can see the results sliding on your screen, so make sure you stick to the end. That said, we go straight at it and show you the first of the 10 trading strategies. The first trading strategy is a seasonal trading strategy. It's called the tax day strategy. In the U.S., taxpayers need to file before the 15th of April. Does tax day signal any bullish or bearish trading signal? Let's find out and backtest the S&P 500. The trading rules are simple, and we buy at the end of March and we sell on the first trading day after tax day. That means we hold the position for about 2 weeks. It shows a pretty steady and consistent growth in the equity since 1960, and the average gain is 1.06%, which is 3 times better than any random period. Seasonal trading patterns are frequent, not only for stocks, and we've covered plenty of them for free on our website. Let's go to our second of the 10 trading strategies. In trading, when you sell is just as important as when you buy, but still most traders focus on when to buy. We'll now show you a sell signal we've used in the stock market for almost 2 decades. To show you its efficiency, we make a pretty standard strategy where we buy NASDAQ 100 when the 2-day RSI indicator drops below 10, and we sell when it reaches 70. This simple trading strategy has been decent, but suffers from many large drawdowns. Let's change the sell trigger to a day where the close ends higher than yesterday's high. You reduce drawdowns, and you also increase profits substantially. This sell signal has proven to work well for stocks for almost 4 decades since futures trading started in the 1980s. The returns with the new sell signal made the strategy outperform buy and hold since the year 2000. Let's use the same sell signal for our next and third trading strategy, where we use the candlestick pattern called dark cloud cover as buy signal. The trading rules for all candlesticks are demanding, but we quantified dark cloud cover into the trading rules you see on the screen. As mentioned, we sell when the close ends higher than yesterday's high. When we backtest the ETF that tracks S&P 500, SPY, we get a decent equity curve. It's not that many trades, but remember, this is just one of many candlestick patterns. For example, if we use the 10 best candlestick patterns, we get the equity curve you see on the screen, which is annual returns of 10% despite being invested only 1/3 of the time. We give you a friendly reminder that you find the trading rules and code for all 75 candlesticks on our website. Let's jump to strategy 4 of the 10 trading strategies. This strategy trades NASDAQ 100 and long-term treasury bonds from the long side, and we use the ticker codes QQQ and TLT. We include interest rates because the growth stocks on NASDAQ are sensitive to rates. The trading rules are on the screen, and they're probably the most complex of all the 10 trading strategies in this video. The capital grows from $100,000 to $1.2 million in 20 years, and drawdowns are small and short-lived. Drawdowns are over 20% only twice over the period, despite being invested 58% of the time. Max drawdown for buying and holding NASDAQ 100 was over 55%, so this is a huge improvement. You make almost 1% per trade, but the average trade is rather long compared to all other trading strategies in this video. Let's stick to using interest rates as a variable for one more trading strategy, today's fifth. This time we use the yield of 10-year Treasury bonds as a filter for when to own S&P 500 from 1960 until today. The trading rules are simple. We own S&P 500 only when the yield is below its 15-day exponential moving average, and we stay out of the market when it's above. The equity growth is not linear, and you didn't avoid the 10-year sideways movement after the dot-com bubble burst in the year 2000. However, you reduce the max drawdown significantly, and you get the same return as buy and hold despite being invested only about 50% of the time. If we flip the trading rules, we get the equity curve on the screen. Thus, all gains since 1960 have come when yields are falling or are low, which is pretty intuitive. What happens if we change the number of days in the exponential moving average? The first column shows the number of days in the exponential moving average, and the three last columns show average gain per trade, annual returns, and max drawdown. It's pretty clear that all gains in stocks come when the interest rates are falling or are low. Let's go to our sixth trading strategy, which is an end-of-month trading strategy for Russell 2000. We buy on the last fifth trading day of the month, and we hold the position until the end of the first trading day of the new month. The capital grows consistently since 1987, but the performance is weaker after 2010, but still positive. For the cash index, which doesn't include reinvested dividends, the performance is better than buy and hold despite being invested only 28% of the time. Our seventh trading strategy is a seasonal short strategy. We short the specific week that's historically the worst week of the year for the stock market, and it happens in the second half of September, the notorious bad month for stocks. The strategy is very simple. Go short S&P 500 on the third Friday in September and cover 1 week later. Since 1960, short has worked amazingly well with an average gain of 0.9%. Short trading strategies are hard to find because of the long-term gains in stocks, so this seasonal short strategy might fit in a portfolio of trading strategies. The eighth trading strategy is about Bitcoin. It's a momentum strategy, and yet again, the trading rules are simple. We go long when Bitcoin breaks above the close 25 days ago, and we sell when it breaks below the close 25 days ago. Bitcoin has had boom and bust cycles, but this momentum strategy has so far managed to avoid most of the brutal drawdowns. Worth noting is the low win rate at 42%. Despite this, the annual return is significantly better than buy and hold, 86% versus 60%. Because most traders don't like to lose, it's mentally challenging to trade a strategy with a low win rate. What happens if we change the look-back period? The table shows that the performance has been solid for a wide range of look-back periods, but the best results are between 20 to 40 days. The second to last of our 10 trading strategies is the Santa Claus rally in stocks. It turns out that Santa comes early to the stock market. We buy S&P 500 on the first Friday after calendar day 14 in December, and we sell on the third trading day of the new year. The Santa Claus season has been pretty consistent with almost linear growth since 1960. The average gain is 1.34%, but you're invested only 4% of the time of the year. If we divide the annual return by the time invested, which is 1.28%, divided by 0.04%, we get a risk-adjusted return of over 30%. Thus, the return during the Christmas holiday is many times better than any random period. The last of the 10 trading strategies uses our favorite trading indicator for stocks. The indicator is called Williams Percentage R. Despite its rather peculiar name, it's proven to work well for stocks for over 3 decades. The trading rules are simple, and this is a typical mean reversion strategy. Buy on weakness and sell on strength. When we backtest the trading rules on NASDAQ 100 using the ETF with the ticker code QQQ, history tells us that this has so far been a solid trading strategy. 100,000 has grown to 1.7 million, and the 3 bear markets along the way didn't ruin the strategy. Annual returns are better than buy and hold. However, slippage and commissions are not included, but they're very low for liquid assets such as QQQ. The returns per year shows that the strategy has performed well during bear markets, but that is of course not guaranteed to happen in the future. Remember, this is not investment advice, but meant to help you get trading ideas. Please do your own research, and good luck trading.